Before we begin, it's my pleasure to introduce you our speaker for today, David Ng. With years of experience in the derivatives industry, David is a seasoned expert in this field. Uh, he previously served as the head of marketing in Philip Futures, where he led the marketing team in driving growth and development of the derivatives industry. Currently, David is a full-time proprietary trader with Iceberg X, a local proprietary trading firm, where he brings a wealth of knowledge and expertise to our session today. And we are thrilled to have him share his insights with us. So without further ado, I am delighted to hand over the presentation over to David. David, there you go.
Thank you, CY, for the very kind introduction. And thank you, the audience, enjoying tonight's webinar entitled Spread Trading Strategies in the Palm Oil Market. There's a lot of myth that comes with talking about spread. I think a lot of us, probably the audience here, majority of you probably are well familiar with trading outright market. Just buying and selling one particular month contract. It's as simple as that. And normally, if you are new to futures trading, normally you start off with that. Spread trading requires a little bit more advancement, a little bit more knowledge, because it involves two different type of contracts. It may not be just only two different months. It can be two different asset classes, as they say. So there's a lot of things involved when you're trading spread. But I hope that in tonight's the next hour or so, we can able to help you to debunk some of the myths, as well as enlighten you to some of the ways for you to kickstart your journey in spread trading. So just before I start, just like to thank Bursa Malaysia as well as Excellent for inviting me today to talk on this topic. And as usual, rich disclaimer, I think anything that presented here today doesn't constitute any recommendation. Do keep in mind the content here presented here today is purely for educational purpose. And dabbling in futures market does involve risk. So make sure you do consult your licensed representative from a licensed broker. And also, as with any other investments, futures trading is not as simple as what a lot of people claim to be. It involves a lot of hard work and a lot of due diligence process into it. So do understand the matter in place before you actually kickstart your journey. And hopefully through all this educational content that Bursa Malaysia is providing, hopefully we are able to get a better understanding before you actually begin your journey in the futures market. So in the next hour or so, we'll probably mainly be talking about spread trading. And as with any other commodities, a lot of people tend to disregard the role of fundamentals. Being an analyst prior to being a trader, I do understand the importance of understanding a lot of these different aspects, especially when it comes to fundamental aspect incorporating into your trading process, because ultimately commodities as it is still a particular asset class that's being traded. So as with any other commodities, if you are trading, you do understand that the basic economics do kick in. So if you trade a commodity that's oversupply, normally you don't expect prices to be that high. Same goes if you're trading a very tight commodity stock. Generally the stock of this particular commodity is low. Generally, you expect prices to be higher. So that's how basic economics does play a role whenever you trade commodities. And the same goes in when you're trading palm oil, for example. So when you are doing spread trading, it's also important and vital for us to actually understand some of the key fundamental factors that actually affect the palm oil market. Given the fact that palm oil does display certain seasonal tendency, there is always a pattern that we can see when it comes to prices. So if you have been trading the palm oil market, you probably know that towards the year end, prices tend to be stronger. It goes with the year end seasonality and whatnot. We're going to discuss that further in the webinar later. But that do take note that fundamentals do play an important role whenever we talk about trading spread as well. Now, keep in mind when you talk about spread, there's so many types of spreads. And I think in particular in tonight's session, we're going to mainly focus on calendar spread. And in Bursa Malaysia, if you just look at the website, for palm oil contract itself, we have exchange listed calendar spreads. It's listed on the exchange. You can trade it as it is. And you can look at multiple different month of calendar contracts that's available, and that's a good thing that Bursa Malaysia do have all these exchange listed contracts for you to trade. And also, I think when you look at trading spread, a lot of people understand that oh look, you're doing two different contract months. It tends to get a bit more confusing, but at the end of the day, it's just talking about the difference. And you can incorporate, same goes as well how you trade outright. You can incorporate technical strategies, which I'm going to discuss a little bit later on in the second part of the webinar, where you can actually use technical charting to apply on trading spread market. So not necessarily you only use technical analysis for trading outright contracts. You can actually also use technical analysis on your spread contracts as well. And I think I will just share with you a simple trading strategy which I use whenever we look at calendar spread, trading calendar spread on the CPO market. So just a basic introduction to CPO, to spread trading. I think the key thing to understand is that when you look at spread, you're looking at two different, either you're looking at the same product, is CPO, by looking at two different months, which is called a calendar spread. So right now that you can be looking at October 2023 contract together with a November 2023 contract. So that's what we call calendar spread contract. Ultimately, what you're looking at is the price difference of these two particular contract months. So a spread involves a simultaneous purchase or selling of one commodity, and you'll be an opposite position for a particular different month or different asset classes altogether. So that's spread. That's what spread is all about. It's just probably talking about the price difference between two different months, two different commodities, two different asset classes. And I think because you're doing different leg on each sides, you'll be buying one and you'll be selling one. That's where the confusion kicks in. Ultimately, what you should be matter more is that you're more concerned with the difference. Are you expecting the price difference to widen further? If you are expecting a price difference to widen further, normally you generally buy you're bullish on the spread. If you're expecting the differences to narrow, that means you are quite bearish on the spread. Then you'll be selling a particular spread. So ultimately, you are just gauging where the differences of whether it's the same, whether the different months or different asset classes is going to go. And that's ultimately what we call, or what our main focus is when it comes to spread trading. Now, generally, a lot of people also uses spread, whether it's calendar spread, as a way to manage your risk. Because keep in mind, if you compare to outright trading, spread strategy or spread trading generally involve lower risk. Why is that so? Because keep in mind you're buying one contract and you're selling another contract, whether it's on a different month or a different asset class. So generally your positions are pretty much hedged. If you're doing outright, you're either buying or selling. So generally your exposure is almost 100%. So that's where when we talk about risk management, people like to talk about spread trading, because spread trading involve dual position. Indirectly, you are actually hedging out your risk. So that's where a lot of people tend to trade spreads because of this risk management that's involved. Now, there's different types of spreads that we tend to look at. I think generally today's concentration will be on what we call calendar spread. So if you just look at calendar spreads, or otherwise also known as intra-market spreads, basically what you're looking at is, for example, if you are trading CPO, you're looking at September and October contracts simultaneously. You could be buying September, selling October, or you could be selling September, buying October. So if you are buying September and selling an October contract, generally you are buying a calendar September-October spread. If you are selling a particular spread, basically you are selling September and buying October contract. As simple as that. And generally, intra-market is usually what we call calendar spread. And keep in mind, if you just look at Bursa Malaysia, the CPO contract is listed almost close to 3 years out. That means you have plenty of different months to form your spread. You just not only be limited to forming a September-October calendar spread. You can be looking at September against November 2023 contract, or you can do a September against December 2023 contract. So it's a series that we are looking at. Generally, ultimately, what you are more concerned is the price difference. And we are more looking towards where the direction of that difference is the difference going to get wider, or is the difference going to get narrower? And that should be our main focus. Now, that's calendar spreads. There's other types of spreads. One will be intermarket. which is ICS. I think recently Bursa Malaysia has also launched a new listed ICS contract between the FCPO and FEPO. So in other words, when you talk about intermarket, is that you are comparing CPO with FEPO, the East Malaysia palm oil market. So there is also a spread they are looking at, and also listed on some Bursa Malaysia. So indirectly, those spreads we are referring to is intermarket. Now, there's also an inter-exchange spread. Now, this is not commonly in Malaysia, but if you look at overseas market, especially on the CME market, inter-exchange is quite popular in the sense that if you look at wheat market, for example, the CME, they all around they have a wheat market, and Kansas wheat market is also quite large. So in other words, they can, if you are a trader, you can always spot a difference between Kansas wheat contract against a CME contract, and you can trade based on those spread. So generally, intermarket spread is not so commonly in Malaysia, but in overseas market is actually quite common. So I think the main focus generally for Malaysian, if you're trading the spread market, is basically the intra-market spread or the calendar spread in particular. So I think essential of spread trading is simple. If you are looking at a price difference between two different months, and you are expecting a particular month is going to go way higher, or ultimately you're expecting the differences to go wider, generally what you'll be doing is that you'll be buying a spread, hoping that as if you buy a particular price differential, hoping that differential will get even wider in time to come. And generally that's what we call a bullish spread scenario. Now, if you are generally in a position whereby you're expecting that whether it's fundamental reasons, naturally in the next couple of months or weeks that the spread will actually narrow. And that scenario, probably you'll be expecting to sell a particular spread because you're hoping that the price differential will eventually narrow. So keep that in mind. I think spread is because of the confusion of having two different contracts simultaneously and having opposite position each other. That's where the confusion kicks in. But importantly, if you're trading spread, all that matters is that the price differential. That's why it's called a spread. And it's important for us to gauge and that's all it matters. You don't have to bother about, if you're doing let's say, for example, you're doing a September-October spread contract. You don't have to bother what's the outright for September. You don't have to bother about the outright for October. All it matters is that, you just have to monitor the price differential between September and October contract itself. So essentially, I think that's what spread trading is all about. So just to give you a brief, now here is all the listed contracts that I just taken a snapshot in recent days. So you can clearly see, August up to November 2024, obviously it's up to 3 years. There's still other listed contracts, but some contracts are not traded, so there's no listed price there. But just for understanding, so if you talk about spread trading, calendar spread in particular, so if you're looking at, let's say, August, September spread contract, what ultimately you're doing is that you're taking the price differential between August and September outright price. So indirectly here, you just take the respective price and you minus it accordingly, you get a spread of -37. Now, if a negative spread is as simple as why is it negative? That means August contract price is much lower compared to September, the month after. So generally in this scenario, that tells you generally the market is actually quite, you usually call this market as a pretty much a contango market, whereby the further months are higher than the current month. Generally, this kind of market is quite a bearish market because the current month is way lower. So generally, what you can see now, if you just take the calendar spread definition, you can basically just take a outright contract by itself and minus respectively the months, you get the price differential. So calendar spreads, all that matters, we are looking at a price differential. Doesn't really matter on what the outright price is. All that matters is the direction of the spread. Now, there will be some scenarios as to where we determine whether should we be buying or should we be selling a spread. Now, generally, I think as simple as if you believe there's a spread for a particular month, a particular pair, let's say September, October, which is a good reference, it's going to go higher for particular reasons. Be it because production is going to be lower, stock levels is going to go down, so you believe that the spread is going to get wider. So in that scenario, you'll be buying a spread. Now, there's also a scenario whereby, in time to come, production is going to kick in, in the next 2 or 3 months or not. And eventually we are now in a very high spread situation, which is really not common. So eventually you foresee or you expect that the spread will naturally widen given naturally narrow given time. In that scenario, probably you should be selling a spread. Now, these are some of the classic scenarios where you can look at whether you should be buying or selling a spread. So if you are expecting the near month which is your current month, and the 5-month contracts to actually widen, normally you'll be buying a spread. Even in both the markets, whether you're talking about September and October contracts itself, is rising. The problem is that there's also will be a price differential between both the markets. So the key thing to take note is that which contract will rise faster. In a rising market, very common. Normally the near month is going to be very more bullish because just take for example last year. I'm not sure many of you are in the market. You're probably aware that during the height of the Ukraine-Russia crisis, you saw the spread of CPO widen I think it went as high as almost 1,000 ringgit difference between the first month and second month. That's never seen before. So it goes to show when in a rising market where both the contract months are rising, if one contract is rising faster than the other contract, generally also will be a good scenario for you to buy a spread, hoping that the gap or the spread differential will get even wider. So that's a scenario where you should be buying spread. Now, same goes if you foresee that the near month, the current month is in the downtrend market. The near month is falling lesser than the further month, or the further month is falling faster. Generally, the gap is also get wider. So generally, in that scenario, also you'll be buying a spread, because generally when you are expecting that the spread or price differential gets wider, that's where you should be looking at buying a spread. Now, at which example that you should be selling calendar spread. Now, example, if near month and far month, near month is actually falling and far month is actually rising, and that's usually where the gap naturally will narrow. That's where you should be selling a spread. Now, it could be also a scenario in the downtrend scenario whereby the near month is falling much faster, especially a downtrend scenario compared to the further months. Generally, that will mean that the price differential between both the calendar months will get smaller. That also will be a good scenario for you to look at selling a spread. Same goes for uptrend market. In a rising market, if the further months is rising faster and the nearer months is not rising as fast, generally the gap will narrow. So in the narrow gap scenario, if you're expecting the gap to narrow, you should be selling a spread market. So that's how you'll be determining whether you should be buying or selling a market, based on how you expect the movement of the respective months itself. And generally that will be a very good basis for you to whether you should be buying or selling. So just to give you a dynamics, you can clearly see, although the lines between August contract and September contracts are very close together, that tells you the price differential between the August and September calendar spread has actually been very narrow. Keep in mind, there's always a question asked, why is there should be a price differential between an August and September contract? Now, in a theoretical market, the further months contract, as you go further out in a month, in a commodity market, generally the further months must be higher, price higher. Why? Because keep in mind, futures contracts are deliverable. There is always cost attached to it. So as you go further into months, there's always a cost of storage, cost of insurance. This will have to be factored in as part of a theoretical price as you go further into the forward months. So that's why the spread tends to be a bit more positive. Now, obviously, markets, these spreads are listed. Markets is market forces and dynamics that's into play. So generally, spreads can also be very narrow into zero, means there's no price differential between August and September contract. So keep in mind, market forces can ultimately still change and alter your theoretical value of a spread. So just to have a look at this August and September price dynamics, you can clearly see that the spread between both the months has actually been quite narrowed for quite a period of time. Keep in mind, if last year you have seen it, last year was actually quite a crazy year, especially during the height of Ukraine-Russia crisis. You saw the spread actually widen to as high as 1,000. We've not seen it. Naturally, I think you talk about theoretical spread price for CPO, you're talking about 40 to 50 spread value, that's fine. But if you reach 1,000, that means there's something that is in the current market that's trying to signal you there's maybe a short in supply. So keep that in mind. I think that's how spread dynamics works. And naturally, I think in a normal market, as you go further into months, the spread tend to be more positive. Now, so what is more concerning is that the way we look at spread. So eventually, as we go, as I mentioned in the past couple of slides earlier on, importantly, if you must have a view on, you must have a gauge of the market. If you're expecting the spread to widen in time to come, normally you should be buying a spread. So this is what happens. Now you have, the blue line is your August contract, and you have the orange line, which is your September contract. Now notice this, August has been trading way below than September contract. So this is a negative spread. And if you foresee that, the spread to widen even further, you should be buying into a negative spread. And true enough, I think the August-September contract has actually widened quite a fair bit. Now this again is due to many reasons, but keep in mind, this expectation of how we see the price differential that matters at the end of the day. Now, so just to show you, basically this is a chart on the spread itself between the August and September contract. You can clearly see, I think throughout, I think last year, the spread has actually been quite range. It's trading about positive 20 to 0. And it finally broke the 0 range and went into negative spread, I think it was early this month, where you can clearly see that, September contract over leading against the August contract. So in this scenario, normally, you can see the price differential will get wider. Now, the thing about spread is that compared to outright, the trend in spread tends to be a bit more stable, in the sense that, if the market is trending in spread, it will tend to trend a little bit longer. Outright, that is, if you talk about outright trading, trend may not be that in place so much, because outright markets can always get a bit of whipsaws, and if you compare to spread trading, the trend journey is a bit more in place. So you can clearly see, I think, the spread itself was trading close to 0, and it finally broke into a negative region, I think just early part of this month, where you can clearly see there's news coming, especially from the Ukraine-Russia conflict, talking about there's shortage of supplies, it's going to affect the market, and that really pushed the September-October contract quite high compared, and August was actually not moving at much. That's why it explains the deep negative spread that we're seeing right now. Now, these are some key benefits of trading spread. As I mentioned earlier, the number one key thing, the key benefit is always about lower risk. Keep in mind, if you are trading outright trading, you are just focusing on buying or selling. It's 100% exposure. If you are talking about doing a spread trading, you are having a long position and short position simultaneously. In other words, your position is pretty much hedged. Now, if you compare the movement itself, outright, just take for example today, outright moves as much as 100 points or 100 ticks on a single day basis. You don't see that in spread. If spread moves on 100 ticks on a daily basis, you just take, for example, August-September spread contract, that's going to be a very big movement. So spread hardly moves as great as outright. So in other words, it gives you a sense of better risk management, lesser volatility as compared to outright trading. Now, if you understand from the Bursa contract specification, spread trading does involve a lower margin as well. So if you because ultimately, you are trading 2 different contract months, it requires 2 different contract margins. But keep in mind, because of the nature of a lower risk when you're trading spread, so therefore the exchange itself is giving you a lower combined margin. So in other words, it enables you to better risk manage, and it also able you to putting a bit more leverage or a bit more size if you need to, whenever you look at doing spread. Now, as I mentioned earlier, if you compare to outright and spread, the trend in spread tends to stay a bit longer compared to outright. Now, again, market forces do play a role, so keep that in mind. But generally, I think when you are trading spread, if you're a trend trader, spread tends to trend a little bit longer compared to trading outright. And I think if you are trading commodities as a whole, seasonality is a very important play. If you just look at CPO, it's a very clear pattern that towards the year end you have stronger prices, and towards the middle of the year you have weaker prices. So if you are doing a spread, you should be selling the middle months and buying the further months, buying end of the year contracts. So that's one way to leverage on this kind of tendency, seasonal tendency, as what they call it. And whenever it comes to talking about lower margins, generally, you're expecting a higher rate of return because you require less margin as compared to trading outright. Now, the last point that which I like to emphasize is that a lot of people will tend to use would just focus on trading spread based on the direction of where the spread is going to go. Now, a lot of those outright traders can also use spread to also express their long-term view of a particular commodity. So, for example, if you are thinking of holding CPO for the next 6 months or so, and a way for you to roll your contract, because every month you have an expiry for your outright contract. So, as a way for you to continue to roll that position or roll that view, you can actually use a spread to move your position forward. So this will get a bit complicated. I don't go too deep on it, but just letting you know, you can actually use spread as a way for you to express a long-term view of the market if you're holding outright position. Now, so just to share with you, basically the chart on the left is showing you a September-October calendar spread. So ATR, which is the bottom panel of the chart, is basically an indicator to tell you how's the volatility of a particular time frame. So you can clearly see, on a hourly chart, the ATR value is about 2 to 3 ticks. It's actually very low. That means the market, the trend market right now in the calendar spread market is actually quite sideways. Now, if you compare to outright on the same time frame and the same period, you notice that obviously the ATR value is much higher. You're talking about 40 ticks on an hourly basis. So it really shows you the dynamics of looking at spread. Outright moves in a very volatile manner. Spread move in quite a stable fashion. But keep in mind, if the trend is on a sideways trend, spread markets can be quite sideways for a long period. But when the market starts to move, when the market starts to display a trend, and spread will also tend to start to display trend as well. So that's where you weigh in the risk and benefit of looking at spread. Ultimately, the dynamics of spread is you are looking at lower volatility as compared to trading outright, where on a daily basis you're looking at easily 40 to 100 ticks range on a scale. No, so these are basically the contract months that's listed on the exchange. So I mentioned calendar spread is a combination of two particular months. I mentioned about August, September, October. Generally, why I mentioned this, because these are some of the most commonly traded calendar spread right now. As we approach closer to the contract expiry, normally we shift over to the next particular calendar spread, which is going to be active. So if you notice, as you go forward into next year, especially 1 year forward, some of the contracts are not traded because there's no view or no volume being built up. But there's a lot of combination that you can look at. So not only necessarily look at August, September, you can look at August, October, August, November, that kind of series and combination. So keep in mind, these are all exchange listed spread. So therefore, the mechanism it works is that if you notice, sometimes if you just take the differential in August, September, and you compare respectively to the outright contracts, the price could be different. Keep in mind, exchange listed, it can be traded. So it is bound to market forces. That's why there's still a difference. Now, in a common financial world, when you see there's a difference, it's basically a free arbitrage. But I think those opportunities is very hard to come by. Keep in mind, eventually, the spread and the outright market will have to fall in place because of the arbitrage opportunity. So keep that in mind. Bursa Malaysia calendar spreads are exchange listed, so they are actually bound to market forces. Okay. So basically, these are all the exchange traded spread. You can look at many different combinations. There's a lot of series of combination that you can form. I'm not going to go too deep on it, but what I'm more on to focus is that you can do different type of calendar spread management. So for example, you can do an August, September, October. These are some, we call it month-to-month basis calendar spread. Obviously, you can do many different combination. Again, the values will be all different. But again, what is more important when you look at spread trading is the direction of the spread. Are you expecting the spread to widen, or it's going to narrow going forward? Now, if you, I taken this back in I think middle June or late June, you notice that the spread behavior is actually quite interesting in the sense that it narrowed quite substantially as we get closer. If you notice, back in middle of May, the front month contracts, especially the June, July, or July, August calendar spread, they were doing about close to deep positive value. I think they was doing about 100 to 150. When you have a high positive spread, it tells you that the current market, compared to the further month markets, is actually very bullish. There's not enough supply in the current market, therefore people are bidding the price higher, and that pushes the current month prices higher than the further months. That's why you explain a deep positive spread. Now, when a deep positive spread starts to eventually narrow, it tells you that the current market may no longer be bullish. The supply is coming in, people are bidding down the price as compared to further months. So therefore, understanding the dynamics of how a spread changes can give you a lot of sentiment interpretation of the market. So I think the reason why June, July calendar spread was so bullish back in middle of May, was that there's a concern that the supply in the market was not enough. And therefore, a lot of people bidding up May, June contract prices way higher compared to July or even August prices. And the spread went as high as positive 150 or even close to 200. Now, that scenario has changed. Now, if you just look at it, you just look at August, September, which is we call it a very front month contract. They are doing a deep negative. They're doing it about minus 47 or minus 50 points. So that tells you how the dynamics has changed just a couple of months. So what this is telling you that generally the market the current market is generally oversupply. In fact, there's so much supply that people are bidding down the price. But there's also a way of interpreting it when you're looking at negative spread, is that people are also expecting that in probably 2 or 3 months down the road, the supply situation may get worse. Maybe because of seasonality or whatnot. Eventually they are bidding up further month prices, and they are not bidding up the front month prices. So that's why it explains a negative situation. So understanding the dynamics of how a positive spread turn into a negative spread is an important element, especially when I try to understand the dynamics of the market. So back in May, we were in quite a tight situation because stock levels were low. Production is not coming in. But as we enter into June, July period, we start to see production coming in. That's why the spread scenario has actually changed quite dramatically in the CPO market. So again, I think bull spread is basically telling you situation or scenarios where you'll be buying a spread contract. So generally, I think if you are looking at hoping that a spread to widen, whether for particular market reasons, generally you should be buying a spread. Now, if you are hoping that the spread market is going to narrow, like what you've seen in this example, a positive 200 spread or positive 150 spread is what we call a temporary situation, because there's a tightness in the market. People are just bidding up the current month. Now, this scenario will not last. As long as given time, naturally the spread market will eventually narrow itself. So in those scenarios, generally people will think that, because of tightness, it won't last. Why not I just take a short position in those spread? It's possible. So in a bad spread market, normally you'll be expecting that when you see a high positive value in the spread market, you're expecting those value will eventually narrow, and that's where you should be selling a spread. So just to give you a dynamics of it, this is September and October spread. Now, pay attention to the bottom panel, which is talking about volume. You do notice that, September October contract was made available to trade last September, so it's almost a year now. So you can clearly see volume starts to build up around March this year. So keep in mind the selection of the calendar months is also important. There's no point looking at February 2024, March 2024 calendar spread when the volume is quite minimal. Focus on the calendar spread. When you choose a particular calendar spread, focus on volume. So as long as the daily volume is sufficient for you to be in and out, that will be a very good calendar spread month to look at. So September, October starts to build volume around March. Take note that the dynamics of the spread itself. Keep in mind, positive spread tells you that generally the market in the near month is quite tight. And we've been trading quite positively right until end of June or early July. That's where we start to see the spread contract starts to turn negative. Now, in this scenario, normally, we start to pay a bit more attention, because when you see a positive spread turning into negative spread, usually that tells you there's something that's changing in the fundamental market, and that normally precedes various higher production or higher stock levels that's pushing down the current month prices. So that's something for us to be aware if you are trading the spread market. Now, again, I think if you just look at it, the relationship between outright and calendar spread, although that calendar spread prices are being derived from the outright prices, do keep in mind they are still exchange listed. That means people can still trade it. In other words, calendar spread itself is bound to market forces. So sometimes there's also a price discrepancy, despite spread contracts derive its value from the outright contracts. So bear that in mind. When that happens, normally there's an arbitrage opportunity, and with the advancement of technology nowadays, traders will be very quick in the market to capture this kind of opportunity. So it's very hard to come by. So eventually, the market will have to adjust back to its natural position. So ultimately, understanding what you're trying to relate is that understanding outright contracts can also help to understand better when it comes to spread position as well. I keep in mind, spread is exchange listed, is also bound to market forces. Sometimes it may differ from outright contracts. So that's where we need to be careful as well. Now, this was I was just taking this July and August contract, which is now no longer listed in the market. This is about a year ago. It's just what I mentioned earlier. Now you notice this is that just last year, when the height of the Ukraine-Russia conflict, you can really see that the spread actually went berserk. It was trading at a range of between 50 to 100 ringgit, which is also not common, because that's generally quite high positive spread. But it went berserk when the Ukraine-Russia conflict get heightened. It went to as high as about 400 to 500 spread value. Now, this scenario again will not last. So generally what people do is that, when they see that, generally they tend to short the particular spread market, hoping that eventually the spread will come back to normal value. So there's a lot of strategy into place, but keep in mind, the trend in spread trading tends to last a bit longer. So if you are trend trading, you look at spread, try to be in the position of the trend. So if the trend is showing you uptrend, stick to the uptrend. If the trend is showing you downtrend, find position for you to sell rather than finding position for you to buy. Okay, so now again, if you compare those listed calendar spread contracts that's available on Bursa, if you just plot their prices all the way on a daily basis, you can pretty much get what we call a calendar spread forward curve. If you notice, the curve eventually get flatter as we go further into the year. Why is that so? There's a lot of fundamental reasons to it. Now, again, there is no specific reason why a spread in the further months are also flat, but the current months are so volatile. There's no particular reason to it, but usually there is a fundamental reasons attached to it. So Jenny, I think, if further month contracts, further month calendar spreads are very flat, that tells you there's pretty much no direction in the market for the next 6 months or so. But when those flat market starts to change, whether it's going to go invert or it's going to go uptrend, that generally tells you that market dynamics has also changed during that time. So keep in mind, understanding of forward curve is important because that generally tells you how the sentiment of the market is going to be in the next foreseeable future. Now, so talking about calendar spreads is one particular spread we have been focusing a lot. Now, there's also other types of spread, which is what we call intermarket spread. So what we have here is that the Bursa recently has just launched the Bursa intercommodity spread between the FCPO and FEPO. Now, again, because of, I think, volume is actually quite low at this point in time. Now, there's always a spread between both the contracts. Again, there's also presenting a bit of arbitrage opportunities between these two contracts. So if you are observing both the markets, there'll be times, there'll be certain scenarios or instances where both the markets actually diverge quite substantially. Now, keep in mind, because FIBO market tends to have lesser volume, so therefore the spread may not be indicative or a very clear indication on both where the differences of both the market is. But generally, I think you can pretty much conclude that FIBO usually trade at quite a good premium as compared to the FCPO contract, given the fact that FIBO usually has a lower volume compared to the CPO contract. So from that basis, you can actually form the direction of the spread. But keep in mind, despite given the fact that FIBO has a lower volume, the spread itself may not be a clear indication of the true fundamental nature of these two markets. Now, so understanding spread is the dynamics of spread and scenarios where you should be buying or selling spread. I think the next important part when you look at spread trading strategy is to understand the fundamental factors that actually underpin a particular trading strategy. I think importantly, if you're looking at the primary market, is to understand some of the key fundamental factors. There's obviously a lot of reasons why CPO prices are affected by so many other various factors, but what I listed here are some of the key factors that actually move CPO prices. Now, I think one cannot discount the fact that when you look at a scenario where if you generally look at a market where you have higher production, higher stock levels, normally your spread prices tend to be lower. Now, CPO, if you look at many years for the past 15 or 20 years production trend itself, it does tend to display quite a seasonal tendency, whereby if you look at for the past 15 years or so, production starts to pick up around April or May onwards. So right now we are in July, and moving into August is where production tend to pick up quite dramatically. So judging by this, we can clearly see that we are in a period where CPO tend to be very weak because production is actually rising. Now, if you look at November, December for the past 15 years or so, generally you look at the production trend itself is actually very it's telling you that production tend to peak around end of October. So if you are doing a contract basis on a calendar spread, generally you notice that any calendar spread that is trading after October, you notice that their calendar spread tends to trade more positively, because if you go into after October onwards, where production patterns start to decline, generally you expect prices tend to be stronger. So that's how you use just fundamental seasonal tendencies as a way for you to gauge whether you should be looking at buying a certain calendar spreads or selling a particular calendar spreads at this point in time. So right now we are in June, July period, August, September period, where production tend to be quite heavy. So generally what you should be doing, you should be selling this calendar spread months because of the rising production that's in place. Now, stock levels is an important indicator, or rather important indication of whether the market is oversupply or not. So you can clearly see, I think last year why the spread has been so bullish is because if you notice last year, the stock levels went from 2 million tons per month to I think it went to as low as almost 1,500 or below 1.5 million. That's actually very tight. That tells you there's generally not much stock left in Malaysia. So with that kind of scenario, with a low stock environment, with a lower production, generally the trend in the spread market will also be very bullish. Because keep in mind, if the current month there's not enough supply, everybody will just be rushing to the market to beat up the price, and eventually will widen up the gap, or widen up the spread. So in those scenarios, you should be looking at buying a spread, calendar spread contract. So these are some of the instances where fundamental factors will actually have a very big role to play when it comes to determining the direction of the spread market. Now, to share with you the relationship between CPO price and stock level, you can clearly see whenever we have high stock situation, generally is not favorable for price. So if you notice last year, if you've been trading the CPO market, it went to as high as above 7,000 ringgit for the first time in history. And the stock levels at that time was actually one of the lowest in the past decade or so. And once the stock level starts to inch higher, you can clearly see actually price start plummeting from 7,000 right down to 4,000 or below 4,000 level. So stock levels are very crucial. If the stock levels are rising, generally you expect CPO prices tend to be very weak. So that's a very good indication here, whether you're trading outright or calendar spread. Understanding the dynamics of how stock levels, production levels affect CPO prices will give you quite a good advantage into expecting where prices will go, especially with the change of direction in the stock and production pattern. Now, same goes, you can clearly see rising production is generally not favorable for CPO prices, and generally you expect CPO prices tend to be very weak, especially when you have rising production period, which you are in right now. Now, coming to export pace, export is also important element because if a rising production is fine as long as export is also picking up. If export is not picking up, especially on rising production, that's where you're going to be a concern, because if export is not picking up and you have rising production, that means stock level is going to rise much faster. So that's an important element for us to take note. So exports seems to be on a good trend, uptrend. I think this month is also expecting to be quite strong, because palm oil is still very competitive compared to other vegetable oil. So that's a very good indication that stock levels may still be quite low at this point in time, which is beneficial for certain calendar spreads going forward. So I'm not going to touch too much on Indonesia. Obviously, Indonesia is the largest player when it comes to production of CPO in the world. So as what is facing in Malaysia, Indonesia is also facing as well. We are facing a period of rising production and rising stock level. Now, I think one of the key aspects when talking about trading commodities, especially when you trade CPO market, is one of key fundamental factors that's always affecting prices is the weather play. Now, weather play is not an immediate thing. If you just look at how El Nino, now El Nino is pretty much confirmed. It's now everybody is gauging the intensity of the El Nino, whether it's going to be severe, mild, or medium intensity. Obviously, El Nino will have always an impact 6 months forward. So if you are trading calendar spread and you have this El Nino in play, be careful of trading next 6 months contracts, especially those involved in the early parts of 2024. Because if the El Nino is quite intense, based on historical perspective, when you have a high intensity of El Nino, normally expect prices, CPO prices to rise as much as 20 to 50%. So keep in mind, El Nino comes in, the effect of El Nino only comes in 6 months later. So keep in mind, if El Nino comes in now, the intensity starts to come in now. Probably you feel the impact only in the early part of next year. So trading those calendar spreads will normally be a good indication of where the market is seeing based on this weather impact. So if you just look at seasonality in terms of prices, you can clearly see, June-July period normally is one of the lowest or weakest point for a year for the CPO market. Generally, that is also in line with rising production, and normally that will be the peak in the production pattern. Again, you can clearly see these are month-to-month change. I highlighted that in color so that's easy to see. We can clearly discern from here is that towards the November, December, or even January contracts, or January month, normally you expect CPO prices tend to be stronger, and that also in line with lower production and lower stock levels. So all it goes hand in hand, and because CPO tends to display that kind of seasonal tendencies or the kind of repeated tendencies, it tends to get a bit more favored when you look at which particular contract months to choose when you're trading the CPO market. Now, I just want to also talk a little bit on the spread between intercommodity, which is in this case referred to the palm oil and soybean oil spread. Now, if you compare, you can't compare apple to apple. There's always a formula that we always want to convert when you're comparing the soybean oil to the palm oil, differential. Now, soybean oil usually trades at a premium. Whether you can attach because of the cost involved in producing soybean oil is much higher compared to palm oil. Therefore, they command a greater premium. But what I'm more focused on is basically the long-term average of the spread. If you just look at it before the pre-COVID time, the long-term average between soybean oil and palm oil premium sticks around $150 per ton. Now that scenario has changed after the start of the COVID-19 pandemic, as well as the Ukraine-Russia conflict. We have seen this spread went to as high as $800 per ton, which is significantly, we have not seen such thing before. This is first time in history. So what this tells you is that despite the long-term average at 150 or 200, spread doesn't always have a tendency to mean revert. Although the mean is about $150 for the past 10 years or so, right now, prices doesn't seem to just go back to its or reverts to its long-term average. So what this tells you is that the dynamics of spread can stay as where it is for a long period of time. In fact, I think we are probably going to be looking at a new long-term average for the soybean oil to palm oil market. Now, this could be a good news for the palm oil market. What this tells you, because the spread is so positive, it goes to show that palm oil market is quite competitive because it's way cheaper compared to soybean oil. That's why the spread is actually quite positive. So it gives a bit more room for the palm oil market to even go higher to catch up with the soybean oil market. So as long as the spread is high, it's actually a good factor for the palm oil market, because of the competitiveness as compared to the soybean oil market. So going to the second part of the webinar, talking about how to apply this based on a technical perspective. You can actually trade spread, on using technical as how you use technical on outright trading itself. Obviously, there's a bit of tweaking. Keep in mind, the outright dynamic and the spread dynamic is totally different because the volatility of the market is completely on a different scale. So I think, but all in all, the methodology that is involved when trade spread trading as compared to outright is actually quite similar. First in every market is that if you're a trend trader, try to identify the trend of the market, whether the trend is on an uptrend or downtrend. That's what we need to do when you first approach the spread market. Now, choosing the calendar spread to trade is also very important. Keep in mind, you want to choose the particular spread pair that has quite a good volume, fair amount of good volume. We don't want to be choosing a calendar spread that's actually very low amount of volume. Normally that will, first of all, it's not that efficient. So if you get in and get out, you tend to get a bit more high. You suffer a bit more higher cost because the bid and ask may not be that great because of lower volume. So choose a calendar spread that is actually quite active and has actually high volume. Now, there's a lot of ways to identify trend, which I'm going to share with you later. And to trade spread on a daily basis, I think one great tool also can be used for any trend trader is to use Heikin-Ashi candles as a way to compensate the Japanese candlesticks. Because from there, we can actually identify the trend on the market in a much easier fashion. And obviously, Heikin-Ashi, you can always incorporate in moving averages as a way to better identify entry and exit signals. Now, with any other plan, especially if you are talking about trading plan, you must have a way for you to exit the market. And one of the ways is actually to use an average true range indicator as a way to measure your risk and reward. And that will be the way that you place your exit level. So just to share with you these two charts, chart A and chart B. Now, if I ask you this question, which particular chart will you be looking to trade on if you are especially a trend trader? Normally people will go for chart A. Now keep in mind, these two charts are same product, same time frame. The only difference is that chart A is actually based on Heiken Ashi and chart B is based on Japanese candlesticks. So Heiken actually helps you to identify the trend of the particular period in a greater fashion compared to if you just use Japanese candlesticks, you tend to get a lot of whipsaws. But keep in mind, if you notice chart B, you tend to see the gaps. While chart A, if you look at Heiken Ashi candles, you don't see the gaps. So if you are someone that is using gap analysis, Heiken Ashi may not be a very good tool if you are looking at understanding or you're trading based on gaps analysis. Now, reason why I use Heiken Ashi is simple because it's easier to interpret, it's easier to identify, especially whether the trend on the market, and because of it's quantifiable, and it makes it a bit more easier to the naked eye. There's only 3 simple patterns that you need to be aware of, to be familiar with when it comes to Heiken Ashi. As long as the body is green, that tells you generally the market is on the uptrend. And if the body of the candle gets wider, that means the trend is the momentum is there, and that you should be riding with the trend. Now, if the body of the candle gets smaller and it slowly becomes the wicks are getting even longer than the body, that's where the market is going to be quite indecisive. And usually, if that's in an uptrend, you start to see this kind of board, the green body starting to get smaller. Is a very good indication that the trend is actually getting exhausted. It's actually quite exhausted. So during that time, it's a good time for you to be out of the market, or it's a good time for you to take a profit on your position. So if you see a red candle bar, that generally tells you it's the downtrend and the body of the candle gets wider, it means momentum is there, and you should be in place for the trend. If you see a series of red and green, and the body of the candles are very small, the wicks are even longer than the body, some dodgy type of candles, that generally tells you that the market is actually heading a sideways market, or the trend itself is actually going to turn into sideways and is pretty much signaling you the end of the trend. Now, I don't go too much on comparing Heiken Ashi and Japanese candlesticks, but ultimately Heiken Ashi is in a way easier to identify. It's able to be quantifiable, and it's more trend following. While Japanese candlesticks is more to identifying when the reversal is going to happen. So it's more of a reversal pattern strategy. So basically, this is Heiken Ashi. You can clearly see, this is a spread contract on August, September. You can clearly see whenever the body of the candle turns green, that usually tells you the potential uptrend is in place. And if the trend of the candle starts to turn red, that generally tells you that market is actually turning downtrend. So that's how you should be looking at Heiken Ashi as a way for you to trade. So same dynamics for the spread contract. You can clearly see, when the trend started to change, you can see by the color of the candles. And generally, if you look at volume itself, volume is a very good indication. If you see an uptrend, the volume is rising, that tells you the uptrend is very healthy. Same goes if a downtrend, and the volume on the downtrend phase is actually quite high, that generally tells you that the downtrend is actually quite strong. Now, obviously, using Heiken Ashi may not be sufficient. What we can do next is to incorporate moving averages. Now, there's many types of moving averages. There's simple, there's exponential, there's weighted, and whatnot. I think key to the matter is that if you compare using simple and exponential moving averages, you tend to notice that simple moving averages tend to be more lagged, lag as compared to exponential. So exponential does it does surround the price quite closely. So whenever the price momentum starts to change, price direction starts to change, the exponential moving average starts to move faster compared to simple moving average. So in that sense, in this respect, we use exponential moving averages as compared to simple moving averages. Now, when it comes to moving averages strategy, it's simple. We use a crossover strategy. So as simple as comparing two different time periods. One is looking at 20 period moving average compared to a 9 period moving average. So the 9 period is what we call a shorter term moving average, and the 20 period is what I call a longer term moving average. So whenever you have a bullish crossover, that means the longer term the shorter term is moving above the longer term. That means a bullish crossover. If it's a bearish crossover, that means the shorter term is crossing below. So if you compare that together with your Heikin and Ashi candles, that can be a very good signal to take as a trading setup. So just to give an indication, so you can clearly see that is as long as the candle starts to turn red, that means the downtrend is pretty much in place. And if you can see there's a bearish crossover on your EMAs, that's quite a good signal for you to take a short position, short entry on a particular setup. Now, average true range, I'm not going to go too much on the derivation of it, but what it ultimately tells you is basically the true range of a particular price movement for a period of time. So the calculation on it, I think you can just derive it from the indicator. But what it tells you is that it gives you an indication of how volatile particular asset classes is at a particular time frame. So just take for example this August and September calendar spread. You notice that the ATR value based on a daily chart, you can clearly see that value is about 10 basis point. So you can clearly see, if you can use ATR value as a way for you to measure your risk and reward. So how the way to do it is that if you notice that it's a very good indication. If you compare the ATR value for a spread contract against an outright contract, spread contract, you talk about 10 basis point on a daily basis. If you talk about outright contract, you're looking at easily 100 basis points. So there's a big differential when you look at trading the outright and the spread. So that is why people will always say that trading spread is actually much of a lesser risk compared to trading outright. Now, I just want to share with you another indicator which I commonly use as well, which we call it a directional movement indicator, DMI. You can usually get it on most charting platform that's available outside. And the derivation of this, I'm not going to go too deep on derivation of this indicator, but what this tells you is that generally there's always two basic indicators to it. One is a positive DI and one is a negative DI. And this indicator usually derives the ADX value. Now, ADX value usually denotes the trend momentum. Anything that is above 20 value of ADX, that generally tells you that the market is going to trend. Whether it's on the upside or downside, it doesn't really matter. Now, how we use DMI indicator is when it comes to trading strategy is quite effective in the sense that if you see the negative DI, which is red color in line, and the blue color, which is a positive DI. If the red DI crosses above the blue line, that tells you generally the downtrend is going to be in place. And if you can confirm it with your red Heikin Ashi bars and your bearish crossover, that's a very good signal to take. Now, keep in mind, when you have a rising black line, which is your ADX value, that tells you the momentum of the trend. If there's the black line is rising, that tells you the downtrend is actually in place and actually rising in value. So that's how we can use DMI as an additional feature. If you want to look at further confirmation, it's not necessary, but if you want to have further confirmation, DMI is actually quite a good tool when you look at trend trading strategy. So here's a very good signal. What you can see here, there's a red Heikin Ashi. The body of the red Heikin Ashi is actually quite white. That tells you generally it's going to be a downtrend in place. Keep in mind as well, there's slightly going to be a bearish crossover on your EMAs. Keep in mind this was quite a side range marker for a long period of time. I think it's also close to a week and a half. And I think today it decided to break below a downtrend line. So it's actually a very good signal to take on to sell the spread in particular. So what you have here is that we just based on a DMI indicator as well. First of all, your rising ADX value that tells you there's a possible trend in place. In this case, it's a possible downtrend in place. And keep in mind, the red line is trading above the blue line. Means negative DI is trading above the positive DI. Again, it's telling you that there is a possible that the downtrend is could be quite enforced. Again, you can look at volume and whatnot, but this generally tells you that the downtrend is pretty much in place. So you can clearly see, you can use the ATR value to measure your risk and reward. And clearly from there you can clearly see that the market or the trend is actually downtrend from then on. So again, you can use a simple trading strategy. If you see a red body candle on Heiken Ashi, the EMAs are going to cross eventually. That would be a very good signal for you to take to sell this particular spread. So white red body Heiken Ashi candle is actually testing the lower moving average. Once you break that, that generally tells you the downtrend is pretty much in place. The ATR value at that period of time is 7 basis points. So you can enter a particular spread at 36 value with an ATR of 7. So normally, you can either take a 2-to-1 reward to risk ratio based on the ATR value. That means you take 14 points as a reward with a 7-point stop loss. So you can take profit at 22 points and your stop loss will be at 43, which is 7 points of your ATR. So you can clearly see, I think the next few candles, it does display that kind of tendency, and it hits your target. So that's where you should be out of market. Now, I'm not a firm believer of having arbitrary stop loss management, which means that there's a lot of ways for you to put stop loss. You can manage it by putting a monetary value. You can manage it by putting amount of certain support or resistance level. So be it. But I think having a plan ultimately to exit your position is a must, because keep in mind, regardless, the market can always move in either direction. And it's best when, because generally when you trade spread, you tend to have lesser gaps. It's not as volatile as the outright contract. But having said that, you still also must have a risk management in place, because if anything, the spread can just turn and the trend will just change immediately. So that's where you can get caught quite easily as well. So no matter what, having a risk management in place is actually very vital. So that's another example of a trade strategy. You can clearly see there's a green body candle here. It's breaking above the EMAs, and the ATR value of 10. So that's a very good strategy for you to take a long position in a spread market. So again, basically using ATR value as a way for you to measure your risk and reward levels accordingly. Okay, I think last but not least, despite all that's mentioned when it comes to technical trading, the last important process for any type of trading methodology or trading process is that you must always track your progress. And a way to do that is, make sure that you journal your progress, you journal your P&L on a daily basis, and especially on what you have observed on the market recently, because all this information is very vital as you progress later on onto your trading journey. Okay, and I think I'm just going to end it with a quote. So I think a lot of traders, I do get this a lot, is that what is the important thing for a trader? And what's the important advice for a trader? This was what given by my mentor. I think if you want, as a trader, the journey that you're going through is definitely not easy. The market is definitely very dynamic. Whatever we have mentioned earlier on, whatever I mentioned today, it may work for a period of time, and eventually the market will self-evolve. And whatever trading strategy that is out there, market will always be evolving, and therefore that will make the particular strategy, it will render a particular strategy quite worthless. So it's the dynamics of our process that's important. So I think the goal of a successful trader is to make the best trades. I think money is secondary. I think Alexander Elder put it in a very nice fashion, and that should be one of the key focus for a trader. So with that, I'm just going to end here. I'm just going to open to the floor for any question and answer. So over to you, CY.